This is Barry Knapp, pardon me, with Ironsides Macroeconomics. It's Monday morning, May 20th at 8:30 a.m. New York City time. We're not in the mountains this week. We're in New York for a Macro Minds conference on Thursday and seeing clients throughout the course of the week. This is the introductory version of our weekly summary of our note, of which you also received if you're a subscriber to our Substack, but not a full client, the note titled Stable but Hotter Inflation. So we discussed the broader macro environment, what the implications of last week's data and our ongoing outlook for inflation are for the markets. We then dug into the details of the CPI report, as well as the economic data that came out last week. The last of the big four retail sales came out on the same morning as CPI, and talked about what that implies for growth through the first month of the second quarter. We then discussed some of the developments in China around the real estate sector and the monthly data, and some final thoughts on the markets. So our big takeaway this week is that we, as our title of our note said, we believe we have increasingly stable prices, but at a above pre-pandemic policy panic trend, meaning inflation is more likely to run above 3 than below 3. And the data we saw last week is further confirmation of that. But that our definition of price stability, anyway, the standard deviation of all item CPI, has fallen, as you can see in the chart, if you're looking at the video version of this, all the way back down to 0.3, which is where it was in the 60s and the 90s, a level that is good news for the corporate sector, is good news for the equity market, for, in particular, for sectors and companies with high operating leverage or high fixed costs. This creates positive operating leverage, and it means higher trend earnings growth. Most companies in those industries are able to pass those prices through. So in the 60s and 90s, those were periods of very strong capital investment. You can't invest if you don't have earnings. But still bad news for the bond market. We think that Treasury should be at least 10-year Treasury should be at least 1% higher, given this inflation outlook and what's likely to be normalization of term premium over time as the Fed shrinks their balance sheet. So the 60s and 90s periods are key. There's a lot of details about that in the notes. The key point of differentiation is in the 60s, inflation was rising, and in the 90s, it was falling. We think this is likely to be much more like the 60s. If we walk through all the inflation details of last week, the key thing to keep in mind is, for all the Fed hand slapping over the biggest decline in inflation, disinflationary trend in 2023, the vast majority of it was attributable to lapping the hot comps and the peaks from pandemic policy panic responses. So in February of 22, goods prices peaked, energy price peaked in June of 22, food in August of 22, supercore non-housing services inflation in September, and housing peaked all the way in February of 23. We've lapped all those comps. We're getting a picture of what the underlying inflation rate looks like. It's higher. We did get slightly better readings on supercore and housing last month, as we expected, but we see no evidence that they're about to return to pre-2010s levels, averaging 0.2 and 0.25 or so. In fact, because of fiscal policy, those are much more likely to run above 0.4 on a go-forward basis. Goods prices are still the majority of disinflation. The only real global deflationary force is China and excess manufacturing capacity. But import prices are starting to improve because of previous weakness in the dollar, and so that's likely to reverse somewhat. So we don't have all that sanguine of an outlook. And if you consider other areas like tuitions, education, and healthcare, which were held down by government policies for a time, those are likely to become excess inflation sectors again. and push inflation back up. So on the aggregate demand side, we did get a weaker than expected retail sales. We got a weaker than expected housing starts numbers. But when you look at some more macro data points like Walmart's numbers, and we'll get Target this week, we're really left with the impression that underlying domestic demand is still running around 3%. Real final sales to private domestic purchasers still looks like it's chugging along at 3, where it's been the last 3 quarters. That's above potential growth, likely putting upward pressure on prices, and growth is still running at a good pace, which is good news again for equity earnings, but not so much for the Treasury market. The Chinese, there's details about the Chinese steps that they've taken and fixed asset investment and how it's all being driven into state-owned enterprises, which is going to degrade their productivity further. So if you want to trade China from the long side, knock yourself out. But we still view the Chinese market as uninvestable. We added some final thoughts on upcoming Treasury supply, sector performance. We would use the recent underperformance, say over the last month, in energy, materials, and industrials at the expense of defensive sectors to add to those energy, industrials, and materials. We see no signs of a healthy broadening out at this point. And we did add some thoughts on bank capital, where the Biden administration seems to be backing away a little bit, and Freddie getting into the second lien business, which is going to be a fascinating development that may very well occur. It's next year's business, but could be a very big deal for aggregate demand and fixed income volatility. Bearing up Ironsides. Have a good week, everyone. Thank you.